Number one stablecoin in entire world, Tether USDT. How it came to this spot and what it had to survive to get to this market-dominating spot is exactly what we will cover in today's video. You can go from knowing nothing to knowing more than 90% of people involved in crypto. And if you are a beginner, don't stress, because every video on Bitcoin Academy is 100% beginner-friendly. All right, without wasting time, let's go at the very beginning of stablecoins. In the wild early days of crypto, where coins like Bitcoin and Ethereum moved up and down like roller coasters, one simple but revolutionary idea emerged. What if you could have a crypto token that didn't swing wildly in price? That idea became the foundation of Tether, the very first stablecoin. Originally launched in July 2014 under the name Realcoin, it was founded by Brock Pierce, Reeve Collins, and Craig Sellers. But within months, they rebranded it to a name that would soon become infamous in crypto circles: Tether. The idea behind Tether was elegant. Create a digital token that's always worth $1. Every USDT token would supposedly be backed one-to-one by real dollars sitting in a bank account. This stable price would make it easier for traders to avoid volatility, move money between crypto exchanges, and even serve as a digital dollar in places where traditional banking didn't work well. Tether initially launched on Bitcoin's Omni layer, a protocol that allowed tokens to exist on top of the Bitcoin blockchain. This made it compatible with Bitcoin's ecosystem while introducing a new type of asset that wouldn't spike or crash overnight. From day one, Tether claimed that every token issued was backed by US dollars held in reserve. That claim would later come under serious scrutiny, but at the time, the crypto world was intrigued. Tether offered something no other coin could: stability. In many ways, this marked the beginning of a new era in crypto, one where people could trade, invest, and hedge without constantly worrying about volatility. Tether wasn't just another altcoin. It was trying to become crypto's version of cash, and that was a bold idea. After its quiet debut, Tether began gaining real traction in 2016 and 2017, not because of big marketing, but because of exchange adoption. At the time, stablecoins weren't mainstream, and traders were looking for a way to protect their profits during high volatility. USDT started to look like the perfect tool. One of the biggest factors behind its early success was its deep connection with a major exchange, Bitfinex. The relationship between Bitfinex and Tether was more than just business. They shared key executives and infrastructure. Bitfinex was among the first to fully integrate Tether, offering traders a way to instantly move in and out of volatile assets without converting to fiat. This new tool became a game changer for traders. Instead of withdrawing to a bank, which could take days and involve KYC delays, they could just switch to USDT and stay within the crypto ecosystem. Fast, simple, and nearly frictionless. As crypto entered its first big bull run in 2017, Tether's usage exploded. It was the go-to stable asset for most centralized exchanges, and the circulating supply of USDT surged to match demand. Traders used it to hedge against Bitcoin crashes, move money across platforms, and settle trades without touching banks. But this rapid growth raised questions. How exactly was Tether printing so many USDT tokens? And where were all these supposed US dollar reserves being held? The company remained vague, avoiding full audits and offering little transparency. Still, the convenience was too strong to ignore. Tether became the dominant trading pair across many exchanges, second only to Bitcoin itself in trading volume. For better or worse, USDT had become the beating heart of the crypto market's liquidity, and it wasn't slowing down. As Tether's adoption surged, so did the scrutiny. By late 2017, concerns started piling up, not just from critics, but from regulators and analysts across the financial world. At the center of it all was one simple but critical question: are these USDT tokens really backed one-to-one by US dollars? Tether had always claimed that every token issued was backed by reserves held in bank accounts. But when journalists and watchdogs began digging, they found inconsistencies. There was no public audit, no clear record of which banks held the funds, and at times, vague or changing statements from the company. Transparency, which should have been the foundation of a stablecoin, was sorely lacking. Then came the first big shock. In November 2017, Tether announced that it had been hacked, losing $31 million worth of USDT. The company responded by freezing the stolen tokens and issuing new ones, something that raised eyebrows about how much control Tether had over its supposedly decentralized asset. But the real storm hit in December 2017, when a paper from University of Texas researchers suggested that Tether may have been used to manipulate Bitcoin's price during the bull run. The report alleged that large USDT issuances often preceded Bitcoin surges, implying that the tokens were being printed without proper backing and used to pump markets. Tether denied the allegations, but failed to offer the kind of independent audit that could clear the air. By now, many in the crypto community were divided. Was Tether a clever, functional tool keeping the markets liquid, or a ticking time bomb backed by nothing? Despite the drama, one thing was clear. Tether had become too important to ignore. It was deeply embedded in trading pairs, exchanges, and crypto infrastructure. Even as doubt spread, usage continued to grow. Tether wasn't just a stablecoin anymore. It was now one of the most controversial players in all of crypto. By 2018, Tether's critics were growing louder, and regulators had started to take notice. The questions surrounding whether USDT was fully backed hadn't gone away. In fact, they had intensified. And finally, the pressure boiled over into legal action. In April 2019, the New York Attorney General dropped a bombshell. It was investigating Tether and Bitfinex, alleging they had engaged in a cover-up of an $850 million loss. According to the Bitfinex, which shared key executives and banking infrastructure with Tether, had used Tether's reserves to secretly fill the gap left by lost customer funds. Shortly after, Tether made a major admission. Despite years of claiming that every USDT was backed one-to-one with cash, the company revealed that only about 74% of the reserves were held in cash or cash equivalents at that time. The crypto world was stunned. This confirmed what skeptics had warned about. Tether was operating more like a shadow bank, issuing billions in tokens without fully backing them with liquid US dollars. The legal fallout was swift. In February 2021, Tether agreed to pay $18.5 million to settle the case with the NIAG, without admitting wrongdoing. As part of the settlement, Tether was required to publish regular reports detailing the makeup of its reserves, a big step toward at least partial transparency. Still, the controversy didn't slow Tether down. If anything, the opposite happened. USDT usage continued to skyrocket, especially in Asian markets, where traders relied on it for quick settlement and access to US dollar equivalents in places with strict capital controls or unstable local currencies. While critics continued to call for a full, independent audit, the market kept moving. For traders and exchanges, Tether remained too useful to give up, despite the legal baggage. By the end of 2019, one thing was clear. Tether had survived its biggest legal challenge yet, but it still hadn't won back full trust. By 2019, it became clear that Tether needed to evolve beyond its original home on the Bitcoin Omni layer. Transactions were slow and costly, and with crypto markets heating up again, speed and efficiency were becoming top priorities. So Tether made a major pivot. It expanded onto other blockchains, beginning with Ethereum. This new version of Tether, known as an ERC20 token, allowed for much faster transactions and lower fees. It also meant USDT could now be used in smart contracts and decentralized finance, which was just starting to gain traction. Almost overnight, Ethereum-based USDT became the dominant form of Tether. But the expansion didn't stop there. Tether soon launched on TRON as well, a high-speed blockchain that quickly gained popularity in Asia. USDT on TRON, known as TRC20, offered near-zero fees and instant settlement, making it ideal for peer-to-peer trading, remittances, and arbitrage between exchanges. TRC20 USDT became a major player in over-the-counter crypto markets, especially in regions with capital restrictions. By the end of 2020, Tether existed on a wide range of blockchains, including Ethereum, TRON, EOS, Algorand, and Solana, making it the most widely supported stablecoin in the world. Daily trading volume for USDT regularly surpassed Bitcoin, a clear sign of how deeply it had embedded itself into the crypto economy. Despite lingering concerns around transparency and the absence of a full independent audit, users continued to adopt it because it simply worked. Tether had successfully transformed from a Bitcoin-only experiment into a multi-chain powerhouse that was now essential infrastructure for the entire crypto space. As decentralized finance or DeFi exploded in 2020, the role of stablecoins became more important than ever. Tether found itself at the center of a new kind of competition, often called the stablecoin wars. New players like USDC, BUSD, and DAI emerged with a focus on compliance, transparency, and integration into regulated financial systems. These rivals published regular audits and emphasized trust, exactly the area where Tether had received the most criticism. But despite that, USDT remained dominant in practice. While competitors talked about oversight, Tether was everywhere. On centralized exchanges, in DeFi protocols, and on trading desks, it was the stablecoin of choice for fast, deep liquidity. Traders used USDT as a settlement layer, arbitrage tool, and store of value, especially in emerging markets where access to dollars was limited. At its peak, USDT accounted for the majority of all stablecoin volume, by a large margin. Its integration into DeFi further solidified its utility. Platforms like Uniswap, Curve, and Aave began using USDT in liquidity pools, lending markets, and yield strategies. Although some protocols preferred more transparent alternatives like USDC, user demand for USDT ensured its continued relevance. The DeFi boom proved that, for many users, reliability and availability mattered more than full regulatory clarity. Tether had survived technical problems, legal challenges, and public skepticism. Now it was thriving in one of the fastest-growing sectors in crypto. Even if the competition was more compliant or transparent, Tether remained the default, and it wasn't going anywhere. As Tether's dominance continued, regulators around the world started paying much closer attention. In the United States, the Treasury Department, the SEC, and other agencies began sounding alarms about the potential risks posed by stablecoins. These warnings weren't just theoretical. With billions of dollars flowing through USDT daily, regulators questioned how much of that activity was backed by real reserves, and whether Tether posed a systemic risk to both the crypto world and the broader financial system. Tether became a prime target. It was accused of lacking transparency, operating without proper licensing, and having links to shadow banking. Journalists, analysts, and lawmakers demanded a full audit of its reserves, something Tether still hadn't provided. In response to mounting pressure, Tether began publishing monthly attestations, third-party reports confirming the existence of reserves, though not with the rigor or frequency of a formal audit. One revelation surprised many. A large portion of Tether's reserves had been held in commercial paper, essentially short-term corporate debt. Critics raised concerns about the quality and origin of these papers, suggesting that if markets turned volatile, USDT could face redemption issues. In response, Tether gradually reduced its commercial paper exposure, claiming it was working to improve its reserve quality. Despite all the scrutiny, USDT continued to grow. For every headline warning about its risks, users across the world continued to transact in billions. It was a paradox. The more people questioned Tether, the more it proved its utility by simply continuing to work. But the message from regulators was clear. The era of unregulated stablecoins was coming to an end, and Tether was going to need to adapt. By 2023, the message from regulators had been received loud and clear, and Tether began to shift its strategy. The first major move was eliminating all commercial paper from its reserves, replacing it with US Treasury bills and other high-grade liquid assets. This wasn't just a symbolic change, it was a deliberate attempt to improve the quality, transparency, and stability of USDT's backing. For the first time, Tether was signaling that it intended to meet the expectations of institutional investors and regulatory bodies, even if it didn't go all the way toward full auditing. To reinforce this shift, Tether began publishing real-time reserve updates alongside quarterly assurance reports verified by third-party firms. While these still weren't the full audits that critics demanded, they were more detailed and more frequent than in previous years. The reports showed growing confidence in Tether's ability to manage reserves responsibly, at least from a risk and liquidity standpoint. As a result of these efforts, and despite all the past controversies, Tether retained its crown as the largest stablecoin in the world. But more importantly, it started to gain traction in areas where institutional trust mattered. Banks, fintech platforms, and cross-border payment systems began integrating USDT as a legitimate settlement layer. In developing countries where access to traditional banking was limited, Tether became a critical financial tool. It wasn't just a crypto trading asset anymore. It was evolving into infrastructure. Tether's actions in 2023 showed that while it might never become the most regulated player in the game, it could still move toward transparency and legitimacy, at least enough to maintain dominance in both crypto-native and traditional financial spaces. By 2024, Tether had firmly established itself as the go-to stablecoin not only in crypto markets, but also in the informal and underserved economies of the Global South. While governments and institutions in the West debated regulation and compliance, everyday people in countries like Nigeria, Turkey, Argentina, and Ukraine were using USDT as a lifeline. In economies plagued by hyperinflation, unstable banking systems, and strict capital controls, USDT became the digital dollar, a way to preserve value, send remittances, and conduct peer-to-peer transactions without relying on traditional banks. What made Tether especially effective in these regions was its simplicity and accessibility. Through mobile apps and messaging platforms, users could send and receive USDT with little more than a smartphone and internet access. For millions of people, this wasn't about speculation. It was survival. USDT offered a level of financial inclusion that local banks and even central banks couldn't match. Its dollar peg provided a level of stability that local currencies often failed to deliver. Interestingly, Tether's more relaxed regulatory posture, often criticized in developed markets, became a strength in these settings. Unlike competitors like USDC that focused heavily on compliance and licensing, Tether prioritized availability and global reach. This approach resonated with grassroots users who cared more about access than regulation. Crypto ATMs, street-level exchanges, and online peer-to-peer platforms embraced USDT as the preferred unit of account. In 2024, USDT wasn't just a crypto asset. It was a real-world economic tool embedded in parallel financial systems across the world, especially in places where traditional finance had failed. And that grassroots adoption became one of the biggest reasons Tether remained unshaken at the top of the stablecoin pyramid. By 2025, Tether had become something of a paradox, the most widely used stablecoin in the world, yet still the most controversial. Despite nearly a decade of legal battles, skepticism, and calls for full audits, USDT remained the dominant force in crypto's dollar-denominated economy. No other stablecoin came close in terms of volume, liquidity, or global reach. It wasn't just the largest, it was the default. Tether's resilience was rooted in its utility. Traders, institutions, and individuals all continued to rely on USDT as a stable base pair, a remittance vehicle, and a store of value in volatile markets. Its integration across centralized exchanges, DeFi protocols, and real-world payment networks made it indispensable. In many ways, Tether had become crypto's version of cash: liquid, fast, and hard to stop. Yet, the controversies never really disappeared. While Tether had made strides toward transparency with real-time reserve reporting and third-party attestations, it still hadn't delivered the one thing critics demanded: a full, independent audit. Regulators continued to circle, and some jurisdictions moved to limit USDT exposure altogether. But at the same time, Tether expanded its offerings, launching region-specific stablecoins like MXNT, Mexican peso, and XAUT, gold-backed, diversifying its appeal and use cases. The deeper truth was that Tether had embedded itself in global parallel economies. In developing markets, it was often seen as more trustworthy than local banks. For traders, it remained the most liquid on-ramp and off-ramp for crypto. And for institutions, despite compliance concerns, it was just too efficient to ignore. By 2025, Tether was no longer just a product. It was an infrastructure layer, a financial utility, a staple of crypto markets. Whether or not it ever becomes fully regulated or delivers a clean audit, one thing is clear: USDT isn't going away anytime soon. And we finally made it to the very end. But wait a second longer. Educating yourself about cryptocurrencies is something that can put you in front of majority of people that don't. So I would suggest watching one of these two videos you see on the screen right now. And if you found this video helpful, don't forget to drop a like, subscribe to the channel, and leave your question or opinion in comment section. Best of luck, and see you in my next video.